This is question number 2 on homework on quiz 6. Analyze and reporting financial statement effects of bond transactions. On January 1st, 2012, Truman Corporation issued $500,000 of 20-year 11% bonds for $462,384, yielding a market rate of 12%. So this is the yield, the maturity. Interest is payable semi-annually on June 30th and December 31st. A. Confirm the bond issue price. Round answers to the nearest whole number. So if you look at the blanks, one is present value of the principal repayment. Another one is the present value of the interest payments. In other words, one is just the present value of this $500,000 because that's the principal. Another one is the present value of the coupon payment. So coupon is based on the 11% coupon rate, and that's in terms of this face value. And also because this is semi-annually, so we need to calculate the semi-annual coupon payment, and then we need to convert this 20-year into actually 20 times 2, which is 40 semi-annuals. So we got 40 constant coupon payments, semi-annual coupon payment. So that's basically this second blank. So with that in mind, we can now directly use Excel. We can figure out the present value of the principal repayment. So this will be simply equals, if we use the present value function in Excel, equals PV open parentheses. The rate here is the interest rate, the market interest rate. So one thing we need to be careful in using this function is that we have to take care of the compounding frequency. So in this case, it's the interest is paid semi-annually. So that means we need to get also to get the semi-annual market rate. So that means this will be 12% divided by 2. And the MPER, this argument here means it's the number of periods until this face value is paid off, this value. So in this case, again, because we are doing the semi-annual compounding, we are doing the same, everything should be quoted in terms of the semi-annual variable. So that also means we need to convert this 20-year into 40 semi-annuals. And because we are calculating the present value of the principal repayment, so this payment here is 0. This payment refers to the annuity, the constant annuity payment. And finally, the future value here should be the face value, which is negative 500,000. The reason I put a negative here is because I want to have a positive present value. Otherwise, the present value will be a negative amount, but with the same absolute value. So now once we do that, and this is the present value of the principal repayment, and now let's change the format to keep just round to the whole dollar as required by the rounding requirement. So then we can copy this number back to this. And the second blank is present value of the interest payments. So the present value of the interest payment. So this will be using the same function. but then here we're just trying to change, just put the argument PMT. So MPER, again, that's 20 times 2, right? Because we got 40 constant coupon payment. So this payment here will be based on, again, I put a negative number because I want a positive present value. So negative 500,000, that's the face value, and then times the annual coupon rate, and then divide by 2 because we want a semi-annual coupon payment. So, and then the face value will be 0 because we are only calculating the present value of the interest payment. So this will be and then again change the format to be consistent with the rounding requirement. And this gives me this number, just copy that back. And now if you add the total, that will become, we can verify this will become the price. Just change that to be the consistent with the rounding requirement. So 462,384, that's exactly the price as quoted. And so we can confirm from that the answers might be correct. So part B, indicate the financial statement effects using the template for bond issue, a semi-annual for first, one is the bond issuance, and two is semi-annual interest payment and discount amortization on June 30th, 2012, and three, semi-annual interest payment and discount amortization on December 31st, 2012. Round answers to nearest whole number. Use negative signs with answers when appropriate. So here we need to basically fill in the blanks, and each of the blank corresponds to either a balance sheet or income statement number. So for one, when bond is issued, obviously the price will, the cash receipt will be the price, right? Because the bond is sold for this. So the cash receipt will be the price that the bond is sold for. So that's 462,384. And at the same time, because balance sheet has to be balanced at all time, right? So this means the liabilities, once the firm borrows from the investors, it also has these liabilities with the same amount, 384. And all other items are 0, right? There's nothing, because there's no interest payment yet, so there's nothing going on with the income statement either. So everything else is 0. And so that's just the 1. And 2 is when the firm made the first semi-annual interest payment, what happens to these financial statements basically? So we can use sort of the we can use the so-called, let me just copy the number first, because I want to make this to be this is net bond net book value. This should be a net book value. Yeah, this through this so-called amortization process, right? This process basically says because right now the firm only gets 462,384, but eventually when the bond becomes mature after 20 years, it has to pay back $500,000. So on the balance sheet, it has to be gradually reflected through a gradual increase of this liability. Otherwise, there will be a huge jump, right, by the final year. But that's not what we should deal with the financial statements. We should gradually increase that amount. So that's called a accrual process, right? Accrual. Um, and in this particular case, it's called amortization. So to use that, first we need to calculate what we call the interest expense. So interest expense is not necessarily the cash paid out or for the interest So interest expense is basically the last outstanding book value and then times the market rate, which is the yield maturity here, right? 12%. And then because this is semi-annual, so we need to divide this by 2, right? And then just keep the maybe it's better to just keep all these numbers to the rounded to the whole number at the same time. So later on, I don't have to do this change for every cell individually. So that's the interest expense. But in terms of the actual cash the firm pays, the firm actually pays the coupon, right? The coupon is based on the face value $500,000 times the annual coupon rate and then divide that by 2. So that is the semi-annual coupon. And then the discount amortization basically is the difference, right? It's the difference between this the interest expense and the coupon payment. That's called discount amortization, and that will be added to the outstanding book value of the debt, and that will become the next outstanding of the book value. So that's going to be this existing amount plus the discount amortization. That's the F7. Should be F7, not D7. F7, F6 should be F6. That's basically this existing outstanding book value and then plus the discount amortization. That's basically what this number is. So with that, we can fill in the second row here. The cash, in this case, cash will decrease, right, by the coupon payment here. It's this amount. Cash will decrease by that amount. And then the non-cash assets, 0. Liabilities. So to figure out that, it's we can first try to fill in this income statement. The revenue is still 0, right? But then there's expense. The expense will be this interest expense, right? So that's what the expense is. Just copy the number there. Interest expense. And then the net income, once we subtract the interest expense, that will be the net income. So net income in this case will be negative of this amount. And then the net income will be reflected as earned capital here as a negative number 2. So earned capital will decrease by this amount. And then the liabilities, as we said, the reason we do the amortization is because this liability will eventually go to the face amount. And so we just need to add the difference between the interest expense and the coupon payment. So that's basically how much the liability have to increase. And if you add up these two numbers, you can also see that will be the same as the left-hand side, the decrease on the left-hand side on the cash asset balance. So this means the financial statement, the balance sheet is still balanced. So that's the road to, and then go to the end of the year, the second coupon payment by the end of the year. So that we're also based on the same process. And then we can just pull the sales now. The next interest expense will be here, right? That's the new interest expense, and the net income will decrease by the same amount, and earned capital will decrease by the same amount, and the coupon will be the constant, right? Because that will always depend on the face value multiplied by the coupon rate and then divided by 2. And then the discount amortization will be the new interest expense, the difference between the new interest expense and the coupon payment. So that will be reflected as the new liability, the increase in the liability. And then we can also get the new balance on the net book value for the next interest payment, but we don't have to do that calculation here, right? So and this will be the same as the cash. The cash will decrease by the same amount because that's how much the coupon is every 6 months. So that's basically, and everything else, we just put 0 there, 0 and 0, 0, 0. Yeah, everything else will be 0. So just make sure we put all these blanks in. And I guess that's basically how we can solve this problem.